If we look at the financial sector reform process overall, which was initiated 10 years ago, it has continued to perform well, despite strains in the international financial system and the challenges presented in the past few years by the financial global crisis, and domestically by the substantial twin deficits. The effect of the global financial crisis have been relatively limited. The banking sector continues to be profitable, it's liquid, and it has adequate capital adequacy in excess of the minimum that's required. The relative resilience reflects the interplay of many factors, including the resilience of the growth process itself, the limited exposure of domestic institutions to the global financial markets, a heavy reliance on domestic deposits for funding, and overall the good supervision by the Bank of Ghana that required commercial bank to build up capital and enabled early interventions in troubled cases. It's good to keep in mind that an important feature of the recent growth has been the role of foreign portfolio investment and direct investment in the banking sector. Now, this has been hit in the past 2 years as many foreign investors or Ghanaians foreign or from the diaspora that have been investing here have pulled out. However, the potential for a reflow remains very positive for the future, and I think it's a source of optimism for growth in the future that remains a strong asset of this economy. Now let me talk a little bit about the moment. I mean, we all live in the short term, someone said, but really it's a moment where it's difficult not to think of the medium term. It's a very unusual moment where there are short-term difficulties, no question, as reflected in the twin deficits, but also oil is around the corner. And so this is a very unusual situation, which I think for bankers must present a lot of dilemmas. But I think it's important to keep these two medium and short-term issues in mind when you're making decisions. And the key issues of the day seems to be interest rates and non-performing loans. So let me say a few words on each. NPLs did decrease dramatically during the reform program. They used to be substantial in the past and they fell a lot, but in the past 2 years they've been going up. They are due in parts to difficulties that businesses had, but in large part they're due to arrears that government has been running from inherited debts and that are being resolved slowly. So they're essentially unrelated to trouble in the global markets, but the turbulence in global markets make it imperative to address them rather quickly, and indeed the growth potential that's out there also requires that those be addressed rapidly. And the solution has to do with a combination of government really trying hard to pay its bills quickly, and the plans are being finalized, but also probably efforts by banks to increase their capital, for example. Issues relating to interest rate are perhaps similar because, again, interest rates went up because of inflation, because of devaluations, but the future seems different. Inflation has collapsed now, treasury bill rates are down, and the expectation, frankly, for the future is that for the first time in history, perhaps, the Ghana CD is likely to appreciate with the foreign exchange that oil will bring. So the situation is quite special, and perhaps the fact that these interest rates, the lending rates, are not coming down reflect the fact that many of you are trying to increase profits a little bit to take care of the NPLs, and that's understandable. But I think the banks among you that are able to strengthen their balance sheet quickly and lower rates are those that really stand now to drive the market, increase your market share, and through competition bring the whole market down, and interest rate down, I mean. And this is really, I think, something that we need to see in the next weeks and months. See that there is a lot of vigor in the banking sector and that these rates can come down now that expectations about inflation and devaluations are also falling.